Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome back Dr. Stephen Perrenod. He is an astrophysicist and most notably to us, a Bitcoin power law expert. Stephen, great to see you.
Nick, great to be on again. Thank you.
Now, ever since our first conversation, I have sunk deeper and deeper into the power law rabbit hole. Now, in a recent conversation with Dr. Giovanni, I understood for the first time that the power law exponent of 6 is actually constructed from two separate network power laws. One being the relationship between time and addresses, and the second one having to do with price. Now, when I saw that one exponent was 2 and the other exponent was 3, and that 2 times 3 equals the 6 that we see with time and price in that relationship that you've taught us to observe, it really did blow my mind. So I'd like to start there, and if you can perhaps summarize your view on this particular aspect of the power law, it would be really helpful to our viewers before we get into your fantastic slide deck and all the visuals that you have for us today.
Yes, that's a great place to start. So the reason why Giovanni calls the power law a theory is because it does rest on some fundamental nature of networks. And we see this in human social networks. We see it in the telephone network. We see it in the internet. We see it with the social media networks, that their value rises faster than the population on the network. As you add a new phone or a new computer to a phone network or to the internet network, that phone or computer can interact with every other, in principle, with every other phone or computer on the planet. And so that means when I add an incremental computer, that there is an n squared effect. I got one more, but he can talk to 1 billion people or 3 billion people. By now, we've saturated with the internet. This idea that the value of the network goes roughly as the square, the number of connections goes as the square. Formally it goes as, n times n minus 1 over 2. It's essentially the square of n. And so it's scaling as a power law, and that power law is a square power law. That's called Metcalfe's law. And people will argue about what the exponent is, and maybe it saturates at very large numbers because not everybody wants to talk really to everybody else. They have closer connections. And so it may flatten out to n log n, but roughly the idea is n squared. So then the question is, in this case, what is the adoption for Bitcoin? And historically, the best metric that we've had is the number of addresses, the number of Bitcoin addresses. Now you have some complications, people will have multiple addresses and some addresses only have dust, but you start with the non-zero addresses or the addresses with at least $100 and you count those and you see how those evolve at time. So what you have is essentially the price of Bitcoin going as a square of the number of addresses. And then you look and see how fast do the addresses grow. And historically, they've grown as roughly the cube of time. So that's another power law. It's a little bit faster. And so, you've got a square of a cube. And a square of a cube, you multiply the exponents together. So you've got price equals n squared, and you've got n equals a cubed if a is the address count. And you get something like a 6 power law. And in practice, what we see is about a 5.8 power law. So it's very, very close to 6.
Now, this is what I want the viewers to understand here as we begin this conversation. The relationship between the Bitcoin price and the number of days that Bitcoin has been alive is a power law with an exponent of about 6. That comes from two places. One being that the address count itself is a cube of time, and the price is the square of the address count. And that's how you get 3 times 2 equals 6. That's where this exponent comes from. And so with that, Stephen, please bring your own analysis. What are you thinking about when it comes to the Bitcoin power law? Why do you believe Bitcoin is heading to $1 million in the early 2030s? And if you can even refine that, and give us your analysis around this topic as we continue to normalize the conversation around Bitcoin going from 6 to 7 figures.
Mm-hmm. Right. Well, it's already gone from less than a penny to over 100,000, 120,000 today. So that is 7 orders of magnitude. And that's happened as the age has doubled 2, 4, 8, 6, 4 times. If we say price discovery sort of started around age 1, 1.5, then that's doubled 4 times. So with the power law, you care about the scaling ratios. In order to get the same increase in price, you need to double the time. But that's a very, very long time for this thing to have persisted, that it's grown by 7 orders of magnitude in price as we've gone, about 1 order of magnitude realistically in time, but that's 4 doublings. So it's still fairly substantial from a scaling analysis. Now, having done that, Occam's razor says it should keep doing it, at least for a while. And there are no obvious hard constraints. The hardest constraint is the total global wealth, 900 trillion or whatever it is, right? We have a long, long way to go to challenge that. So we go to 1 million, it's 8 times from here. It's not that much in terms of the way the price scaling has already been. You do require more and more capital coming in, but there's an interesting phenomena, which is to get large institutional capital, you want the price to be high. It doesn't affect their books, their balance sheets, if it's not a very substantial asset. So the bigger it gets, the more very large institutional capital it attracts. And this is why collectively the Magnificent Seven have almost no Bitcoin position so far. That will change.
Now, when we think about it's not that much, what you're saying is that for Bitcoin to get to $1 million, it only has to 8x. That's less than the increase in order of magnitude already, because we're past $100,000. So what is the relationship then between how much capital has to come in to drive that price, or is that not how you think about it as the network grows?
Yeah, we do think about that. The capital is just the first derivative of the power law. So if the price is rising as t to the 6th, the change in price is the first derivative. So it goes as t to the 5th power. So the capital has to increase with the 5th power of Bitcoin's age. And, there's a market multiple ratio in there. One can go back and look at that. It varies a lot during bubbles, but it tends to average around 2.5. It's essentially the same as this MVRV statistic, right? So that is just, a first time derivative, which makes it a t to the 5th. So the capital going in has to rise very quickly as well. And we've been seeing that. That's why the price has been sustained.
Over 10,000 investors downloaded the original How to Position for the Bitcoin Boom report when Bitcoin was 27K and it called for 120. The target is hit. What's next? Tour de Meester is back with the 2025 edition, refreshed for the mid-cycle moment. New data, new insights, and get Tour's latest price expectation. Plus, you'll get exclusive access to charting our way through chaos. Tour's new 30-minute Q3 2025 presentation. He explains why this bull run might just be beginning. Read the first ever mid-cycle report from Adamant Research at unchain.com/TBL. Blockstream, where the future of finance runs on Bitcoin. Go to store.blockstream.com and use code TBL for 10% off. Pick up a Jade Plus hardware wallet. It integrates seamlessly with your Blockstream app, and it's the perfect way for both pros and beginners of Bitcoin to get started with your cold storage. Store.blockstream.com. Use code TBL for 10% off.
Here's the agenda, and I don't know if we'll get through all of it, Nick, but we'll certainly talk about various aspects of the power law as we go through this. I wanted to start out with just the concept that we have money 3.0, that this is a foundational technology revolution in money, and that at the base, this is monetary technology and needs to be considered that way. I'll talk a bit about the difference between power laws and exponentials, because people often have exponential hopes for Bitcoin, and that is because I think they got caught up looking at the bubbles, which do have exponential behavior, and your eye gets drawn to those when you look at a log linear graph. But when you look at a log graph, the bubbles are not nearly, they don't stand out nearly as much. I'll talk about hashing a bit, how zettascale imparts value, and then the persistence of the power law that we've just had a little bit of discussion. And importantly, I want to talk about the distinction between the core region and the bubble region. And they're roughly equal in time, with the bubbles rising and then falling. And then I'm going to talk about how Bitcoin does not adhere to efficient market hypothesis. We have alpha, and we have alpha in spades. And a way of evaluating that is called the Hurst exponent. So I'll talk about that. I'll talk about the bubble decay trend. Volatility has been coming down. And then if we have time, there's some other topics around Kelly criteria and around liquidity, and even a different sort of power law, which is just used for bubble analysis, called the log periodic power law. So let me dive in, if that's okay. Yeah, so energy is digital money. The first proposal of which I'm aware comes from a Nobel Prize winner in chemistry. I only recently became aware of this. It was 100 years ago, 1921. He wrote a monograph called Wealth, Virtual Wealth, and Debt. And he noted that wealth originates from energy transformation. Debt grows exponentially, whereas real world wealth has growth and decay. And he called for an energy currency. His name is Frederick Soddy. There are others who have been noted, particularly Henry Ford had talked about the idea of money based on energy. And Buckminster Fuller also did in the 1960s. And then the whole thing kind of got rolling, 40 years ago with David Chaum and digital money and, many contributors over the period up until Bitcoin was first released. Here's a quote from Buckminster Fuller. He said, by the year 2000, there will be a realistic scientific accounting system. Wealth is energy. There are actually two things that stand out here. One is that it's a scientific method. It's a scientifically precise definition of money, a monetary standard that has absolutely finite and has 15 digits of decimal precision. And the second, of course, is that it's rooted in energy plus cryptography. And he was only off by 9 years in his prediction. And he made that prediction, 40 years prior to when it was released in 1967. So I say Bitcoin is the first completely scientific standard ledger and the first direct from energy monetary system for enumerating wealth. Unbounded energy into absolute finite Bitcoin. There's no limits on how much energy can go in. Right now, it's about 21 gigawatts continuous, and that's producing nearly 1,000 exahashes a second, which is also 1 zettahash. And this chart just has a comparison of gold and fiat and Bitcoin as money 1.0, 2.0, and 3.0 against the attributes that Aristotle identified over 2,000 years ago of durability, portability, divisibility, and intrinsic value. And I've added one more, which is fungibility. And basically, Bitcoin wins on every criteria. Also, this is one of the most valuable pieces of software ever. Windows has had $2 trillion in revenue over 3 decades. Google search and ads, that's about $2 trillion in revenue over 2.5 decades. Bitcoin, which chat called the most disruptive, has 2.4 trillion market cap today, and that was done in 1.6 decades. Just a little comment on the cryptography, because it's very important to the value that we have this zettascale or 1,000 exahash scale cryptography and large amounts of energy in support of that, tens of gigawatts. There's been an evolution in terms of the mining hardware. It started out with CPUs. It shifted to GPUs. There was a little bit of activity around FPGAs, but it quickly went to ASICs. And the first ASICs in 2013 gave a leap of about 100 times over the GPUs that had succeeded CPUs already by 2011. And now we're at 5 nanometer ASICs, and we're in this range of 300 to 800 terahashes per mining rig, or per ASIC. And there's 4 nanometer technology that's in design now. So this is, cutting edge technology, nearly quite the same as where the, latest NVIDIA GPUs are. There's been an increase by a factor of 1 million in the past 14 years in terms of hashing per ASIC. And actually relative to the GPUs that we used 14 years ago. And one of these hashes is not a single operation. There are about 1,600 low-level bit operations within the double SHA-256 hash in this counting. And what that means is that there have to be several million mining rigs operating continuously. I call this the world's largest decentralized supercomputer, and there are tens of billions of capital dollars invested in the network. And the proof point that this matters is just to compare Bitcoin with Bitcoin Cash. The supply is the same. The algorithm is nearly the same. It just has a difference in the block size. The halvings happen on more or less the same schedule. The difference is Bitcoin just attracted much more attention to its network, and it manifests a power law because it got to a critical scale of network growth. Bitcoin Cash really doesn't manifest a power law very well. And the exahash rate, if it's 850, I haven't checked the latest today, but this is recent. Bitcoin Cash about 4.5 exahashes. A price now 120,000, and for Bitcoin Cash in the 500 to 600 domain. So if you take the ratio of price to exahashes, it's about 130 or about 120 for each of these assets. So hash rate really matters in terms of imparting value because it imparts security and it attracts people to the network, both through the fact that it attracts miners, but also, it attracted the pools and it attracted the exchanges, and everything snowballed from there. Now on to power laws. Power laws are ubiquitous in nature. Here are 4 examples, and you can have different exponents. The first one, black holes, is just the radius of a black hole proportional to mass. So that's a simplest kind of linear relationship, but that's a power law with an index of 1. The second one is gravitational waves. It's actually the time. If you have 2 black holes that are in a very tight orbit, and therefore it degrades through the tidal interaction, they in spiral and they merge, you get gravitational waves that were finally detected from 10 years ago. And this is an area Giovanni actually worked in as a physicist. And the time for the in spiral is a power law of the separation between the 2 black holes. And it's a steep power. It's the distance to the 4th power. The next one is for decay, and it has to do with cross sections and so forth. And you see a couple of power laws there, a square and an inverse of this parameter, which is a scattering parameter. And the last one is the Higgs boson, and that's the Lagrangian. It's the energy that depends on the field strength, and there's both a square term and a 4th power term. So in the fundamental laws of nature, which there are 4, all of them are power laws, either purely or have power law components. And then they may have exponential components as well. For example, the weak force, the weak nuclear force, has a decay component because that's what it does. It governs decay, but it also has power law component. And that decay component is exponential. Now, in financial assets, we typically see exponentials. We don't see power laws. In stock prices, we just typically don't see power laws. We see exponentials up and down, and they get steeper and flatter. And if you're wondering what this exponential is, because this is a log linear plot, so the axis has the value, the y-axis has the value in a log compressed chart. You can see the numbers getting closer and closer together. But the x-axis, which is time, is linear, and it's basically a straight line in a log linear plot. If it's straight on a log linear chart, it's an exponential kind of relationship. This is the S&P 500, and it's from the bottom in the great financial crisis around January 2009 until now, and it's been a 12% compound annual growth. Constant compound annual growth is an exponential function. And the formula looks like has 2 parameters, some constant times an exponential of time, but there's some characteristic time. And the characteristic time is the time to grow by E, which is the base of the natural logarithm. Or you can think it's, the doubling time, which would be quicker than that. So 7% compound annual growth, that doubles in 10 years. So that's how exponentials behave. Now, power laws can be straight lines, but you have to plot them on a log-log chart. So this is Bitcoin, and this is the log of the price extending over 6 orders of magnitude from when it was less than 10 cents to over $100,000. And the chart is a log of age. So you'll see the log of age 1.0, that's 10 years. So I've added to help visualize things or help the viewer. I've added 2, 3, 5, 10, 16, the linear years as well. And you can see that time is squeezing as we go further out. So what do you see? You see straight lines, but you also see bubbles. And there are 2 types of regressions that I've done here. The black line that goes through the middle, it's called OLS, that's ordinary least squares, very typical regression technique. And that shows an index, a power law index of 5.69, so close to 6, right? Now the others, the red solid line plus the dashed lines, are another regression technique that's called quantile regression. And what it does is it looks for the best fit that would put 20% of the data above the line and 80% below, depending on what your level you set. So the red line is the median level, it's the 50% level. And so half of the data will be above and half of the data will be below if it's on a log terms. And that one has a slope of 5.83 or a power law index of 5.83, even closer to 6. Now, you can get a trend value, what's the value projected along the line? And with the OLS technique right now, you'd say it's 105,000. And with the quantile regression technique, you'd say it's 94,000. So we're above the line, not greatly, but significantly, about 20,000 above the mean of those two. And then I've also shown the projections out to a year from now. What would the value be just along the power law main trend? And you can see that the black line and the red solid line are getting closer and closer together at the present. Little typo, missing a decimal point, but basically 139K is the geometric mean of those two for a year from now. Now, we can get bubbles that rise above those, but what you see is that the bubbles fall back, and they fall back through actually the best fit mean or median regressions, and then they come down to kind of a baseline, which is the QR level at around 0.2. And there you have, only 20% of the data is below the line and 80% is above.
Now, Stephen, can you cut through the math real quickly? And your last bullet point here is that it's still greater than 40% year over year trend. I recently did an episode trying to just plot out the compounding annual growth rate at 30, 40, and 50% to show the viewer when the current price compounding will get to $1 million. And we got sometime between 2031 and 2033. So if we're using 40%, I believe that was 2032. When does that, if we're using a power law, how do we think about, for the non-mathematicians out there, when that 40% goes into the 30s? How should one think about the growth rate declining over time potentially, or is that a much longer time scale?
No, it falls a few percent every year.
Okay.
So the formal expression is in that line, 1 plus 1 over t, in parentheses, raised to the k power. So t is the age, which currently is 16.6 years for Bitcoin. K is the index, which could be 5.7 or 5.8, depending on which regression method you use. And then you just evaluate that. Now, to first order, you have to subtract 1 from that, right? Because that, if you put in t of 16.6, 1 over that is like 0.06. So you get 1.06 raised to a power that's almost 6. And then you have to do a Taylor series expansion. The first two terms are sufficient. But to first order, it's k over t. So it's basically a number like 5.7 or 5.8 divided by 16.6. That's your percentage. And then you've got this second order term that bumps it up a little bit. But you can imagine k over t, 16.6 divided by 5.8. You can imagine, the other way around. 5.8 divided by 16.6. You can imagine that that's number like 0.4, right? And so every year, t increments by 1. And so it's going to drop by the ratio of t plus 1 over t. So as we go from 16.6 to 17.6, it's going to drop by about 6% of the 40%. So it'll drop by 2.5 percentage points a year from now. In other words, the projection right now for the next 1 year is about 41%, but then a year from now, the projection will be 2.5% lower.
Thank you for explaining that.
Okay, this works for gold. It works for the euro. I don't have a euro chart, but this is a gold chart. It works for, any of the fiats that aren't suffering from hyperinflation with slightly different power laws. If you use a quantile regression on gold, you get a 5.58. So it's not quite as steep because gold has been doing better than the dollar. as we know. But it's not that different from the 5.83 that you get against the US dollar. The other thing you see is that these quantile lines, the 0.05, the 0.1, and the 0.25 are the three at the bottom, are much closer together at the bottom than the ones up at the top. The 0.75, 0.9, and 0.95, which are the green and blue ones, are more spread out because they're populated by the bubbles as opposed to the core. What we know is that Bitcoin skews right heavily, right? So you come back to this core, it's pretty solid, and that's your long-term support. And then you've got these bubbles with exponential, even super exponential rises and falls, but they keep coming back to this power law. So this is another reason why we have confidence in the power law continuing to persist. Okay, now here's a demonstration that we're not exponential. Very simple. And this is model free. This chart doesn't assume any model except for that dashed line. It assumes an exponential model. This just looks at the four epochs between the four halvings and says, with the orange line, what was the average monthly return? And it's dropped from 30% down to about 7% in the fourth epoch, which is the epoch that ended with the halving in April 2024. And in the same fashion, the volatility, this is the volatility of the monthly returns, dropped from 80% down to 25%. If it were an exponentially behaving asset, you would be along some dash line. For example, if everything were 20% per month in return or in volatility, it would be flat across these four. Bitcoin does not behave like an exponential. And in fact, this is consistent with the power law. You get a little bit of a bump, apparently, from the bubbles that kind of diffuse some more energy into it, but it's much more consistent with the power law. And this slide shows how the power law developed over history and became more stable. So we have our Bitcoin price in green. This is a log linear chart. And on the y-axis, I've got a power law index. Instead of having the price on the left-hand side, the price is on the right-hand side for the green line. And what I do is, back in 2011, I say, okay, based on the price history, what would the power law be? It would be an 8.4 index. And you had a big bubble in 2011, so it drove it up even above 10 and above 11, approaching 12. But then when that bubble was over, it fell down drastically, all the way down to 5.3. And then you have a bubble in 2013 that pushed it back up to the 6.6 neighborhood. And then post bubble, it dropped back down below 6, dropped down to 5.5. Ever since then, it's been quite stable.
And I want our team also to pay close attention to this slide, because it's a conversation Augustine and I had recently, Stephen. We were talking about, I'm always a believer in doing the numbers yourself. I went on CNBC India and said Bitcoin is going to $1 million over the next 10 years. But then I had to come back to Microsoft Excel to just show myself before the viewer the path to get there. So I was explaining to Augustine, hey, let's go with the current exponent from the model and just use that, freeze it. We don't have to. He said, do we have to iterate the exponent that we derive the power law at all times? And I told him, no, the power law has stabilized in that we can pick an exponent. I know that's less scientific than you're probably hoping for, Stephen, but we'll pick one and that will be our power law price. And we can use that to anchor and express to, let's say, the reader, a daily growth number. Bitcoin is expected to grow by $10 today based off of the power law, for example. So I told him, let's just pick one. Now I want him to also see here, and our viewers and our readers, that the power law exponent is stabilizing in that we don't have to restrike our exponent on a daily basis. Could you comment on that approach?
Yes, I think that's fine. You, that band around this line has gotten very, very small, and that is the one sigma error, the standard error on the exponent itself. And it's tiny. I don't know what the number is. I've forgotten. It's 0.07, some number like that. So we can say that the exponent has been between 5.5 and 5.8 since 2016. And
A
it's,
decade, yeah.
it's for a decade. It stabilized after a decade, really, after the first two big bubbles. And the bubbles have been getting weaker in relative terms. So absolutely, it's fine to project, pick one now, you can use it for a year, and then you can go back and recheck.
Can you, before we go into the rest of your slides, can you comment on the current Bitcoin bull market and how you see the debate between the halving cycles being over versus muted versus another bubble type behavior is coming later this year before the end of before the next halving cycle starts to come into view? Can you give us a comment, and maybe you're just anchoring your analysis in the power law theory itself?
Yeah. Well, I'm going to separate the core and the bubbles and show how those are behaving and how the bubbles are decaying. And so the halving cycle has been losing its power. And that's not surprising because, we went from 10% inflation to less than 1% inflation in supply. So the halving cycle is now objectively irrelevant compared to the institutional buying. The corporate treasury buying and the ETF buying are dominating. And so the halving cycle at least has weakened substantially. And I think the liquidity cycle is more important. Things can happen. We've got uncertainty, but once you separate the core and the bubbles, you'll see some amazing tightness in the core behavior. So it's all about what kind of bubble do you get, and the bubbles are weakening, and I'm going to show you that. First, I want to show you a little bit. Maybe I'll move quickly through this because I want to get to the bubble separation. But the efficient market hypothesis was reviewed in 2021 for Bitcoin. And there are a bunch of different statistical tests that are used. I've highlighted ones that we use. We've used several of these. And in that literature review 4 years ago, they found that 20 out of 25 studies rejected the hypothesis of mean reversion, the efficient market hypothesis that we know, for example, the S&P pretty much adheres to. And one way of studying that is with Hurst exponents. This is a little bit of history about that. It's been around since 1951. It's been used in a bunch of different domains, including geophysics. It started out in hydrology. It's been used in neuroscience. It's been used in analyzing internet network traffic and of course in finance and economics. And itself is a power law, but what it does is it's a statistical method where you have all your data, but then you chunk it up and you have windows of different size in and you vary that size. And then you look at the standard deviation and compare how much of a range you get as you get larger and larger windows. How does that range grow relative to the standard deviation? And it turns out it will grow as the size of the window to some exponent power law, which is called H, the Hurst exponent. And if that's 0.5, it turns out that's a random walk. And if it's less than 0.5, you have mean reversion. And typically, it's at most 1. And if you have over 0.5, you're trending. And the more it's over 0.5, the more you're trending. So I've analyzed this with Bitcoin. The important thing is you want to first take the power law and detrend the data, because you've got to detrend the data when you do this Hurst analysis. And so I used the log residuals relative to the power law. I took the full price history I did this with respect to the dollar. I did it with respect to gold. I did weekly. I did daily. You kind of need the daily because you want to have a lot of data points because you're slicing this thing into smaller windows. And the answer is 0.9. 0.9 in a Hurst exponent that can run from 0 to 1. And this graph, the bottom's at 0.5, which would be random. So we're very, very strongly trending. If you do this analysis for the 10 years of SPY, and I did this myself, you get an H of 0.18, very close to mean reversion. This is how the Hurst exponent developed over time, these dots. And what you see is across this history of more than 14 years that it stayed above 0.9, even as you went through bubbles and came back from bubbles and so forth. This says we have a lot of alpha that the market hasn't recognized. It's barely come down at all. It's still above 0.9. So this I call proof of alpha for Bitcoin. Now, getting into the difference between the core and the residuals. I mentioned that Bitcoin is highly skewed. So this shows a histogram of the log 10 residuals after you subtract a power law. And you see that they're basically two peaks. The big chart is against the dollar. The small chart is in gold. It's apparent in both. And so I've fit it with two Gaussians. It's a pretty good fit with two Gaussians. So those are log normal distributions, right? And in fact, I ran a hidden Markov method against this, and it came up with the same conclusion that a bimodal Gaussian mixture model is significantly better than trying to fit it with a single model like a gamma model that has a long fat tail, because that doesn't capture the double bubble or the two peaks nature of the dual Gaussians. A lot of detail on the hidden Markov method, don't worry about that, but it recognizes, based on this assumption that you've got two states, which state you're in at a certain time, looking backwards. And it might be a little slow to transition, but then it goes into the bubble state from the core. And what you find is over the history, it's really been quite sharp transitions. Once you went into the bubble, you stayed in there, you rose and fell, then you got back into the core and later up into the bubble. And there are very few kind of fake outs in here. It's pretty sharp transitions. We had one at the very end of the year that was taking us up into the bubble. And then, as you know, earlier this year, we fell back. And so now hopefully we're positioned to go back up there again. So once you understand this nature that you've got these two distinct phases, a bubble phase and core power law phase, if you remove the bubbles and just redo the regression analysis on the other half of the data, which is the core power law data, you find extremely high R squareds of 0.998 and 0.997. You have very, very tight relationships. And you can see how all the quantiles are really right on top of each other. And again, this is over 6 orders of magnitude in price. So that's how tight the power law core is. Here's another way of visualizing the bubbles and the power law core with, again, these are the residuals once you've subtracted out a quantile regression. And I've added, in this case, there's 3 states. There's a transition zone. So I did a 40-20-40 division. So the transition zone was the middle 20 of the data in residuals terms. And the lines and the shading through the bubbles represent the one sigma variation, and the same for the power law core. And you can see the power law core is pretty flat. The bubbles do their thing up and down, and the transitions are sharp. You go through the yellow region, you get into the red region, and you stay there until you come back down. And you do that repeatedly. So the idea in terms of a physics analogy is the difference between laminar flow, smooth flow for a fluid, and turbulent flow that's chaotic high energy flow, which would correspond to the bubble phases, where price grows exponentially and then collapses exponentially back to your core power law. This diagram is of your aorta, your largest blood vessel, and this happens, with every heartbeat in your aorta. You have laminar flow, and then you transition into turbulent flow. Hopefully, not too much turbulent flow, because that would be indication of blockage. But this gets studied, this transition, for cardiology. So here, the small chart shows the two Gaussians, the core and the bubble. You can see how well separated they are. And then here I've done a rolling 4-year mean of the average residuals. And so it dropped from 0.5 in the log for the bubble down to 0.2. That's very substantial. In linear terms, that means 3 times above the overall mean, dropped down to 2 times, and now down to 1.6 times as the kind of centroid of the mean, the overall trend for the bubble. And then for the core, it's much flatter. It's a green line, and it's about 30% below. It's about minus 1.5 in log 10 terms, where the overall mean for the collective data set is that dashed line at 0. And the bubble to core price ratio has come down more or less as the reciprocal of Bitcoin's age. Purple is the historical bubble to core ratio, and the yellow is dashed line is the reciprocal model fit. And again, it's come down from nearly 5 to 1 to close to 2 to 1 in terms of the average price in the bubble and the average price in the core. This shows the volatility. The volatility in the bubble has dropped from 100% down to about 37% now, and you can fit that with the reciprocal. And you can see for the core, it's very flat. It's been around 20%. So these are converging. I think, bubbles are a little bit evaporating. I'm not sure how big a bubble we're going to have this cycle. But you can use this as a forecast technique. So this is a new forecast method to separate out those two and say, how much is the core mean how much is the bubble mean above the core mean? And then just look at the data within the bubble and say, what are the +1 and +2 standard deviation levels? So if we forecast to the end of the year, which is age 17 or the beginning of 2026, and use this technique of separating out the two and having their own, the two Gaussians, then a 1 standard deviation would be 185K. That's 1 standard deviation within the bubble. And then 2 standard deviation could be 234K. But that's only a 1% chance of reaching that. But still quite decent relative to where we are now. I call this the yin and the yang of Bitcoin. So the yang is structure and growth and sustainability, the core power law. And the yin is the chaos and the volatility and the speculative, more emotional periods. And as we know, the bubbles get ruled by FOMO. I think liquidity is important in kicking them off, but FOMO is what carries them through.
I want to ask you about the proof of alpha comment that you made and backed it up with that trend exponent, or to the exponent, Hurst exponent, to show that Bitcoin is trending and actually a source of alpha, not mean reverting, not adhering to the efficient market hypothesis. My question to you is to step out of the mathematician's mind and go into general awareness. Where do you think the world is in terms of understanding the mathematical inevitabilities behind Bitcoin's network growth, which you lay out and which the power law explains for us? Do you see any awareness of this broadly starting to come into the general mindset, even perhaps the institutional investor, or not?
I think it's low awareness now. My somewhat flippant comment is that 1% of people get Bitcoin, and 1% of that group gets the power law. And then even from that group, only 1% get or grok this strong distinction between the core behavior and the power law behavior. So I think it's early, and people keep asking me about Saylor and his model, and I say his model is not well founded because it's a spreadsheet with arbitrary stair step plugged into it, and it's 3 cases: bear and bull and base, and there's such a wide variation when you get out in the future, 20 years from now. But more importantly, if you take those same rules of the model and project them backwards, they don't fit the history. So they're not grounded actually in the history of Bitcoin. It turns out that his base model looks a little bit like a power law, behaves a little bit similar in terms of the numbers, that gets plugged into the spreadsheet. But so I even question whether he understands the power law and he understands so much about Bitcoin. I'm sure there are institutional investors who have come across it and considered it. And but what I don't know, we don't have enough feedback to know how widely that's happening.
We hope to bring more and more attention to it as it becomes a core part of my framework. And you would be absolutely delighted to learn that this summer, while teaching Bitcoin, one of my students, an excellent student from Canada, gave his final presentation on Bitcoin price and on his own put a Dr. Giovanni power law chart in there as one of the supporting arguments for why Bitcoin is heading to $1 million. So it's fantastic to see. I wanted to teach power law in my class, but you only have a certain amount of time, and the what is money component becomes so important especially for the young students to learn that power law falls down, or it fell down my curriculum list, but I can see it charging higher and higher as time goes by because of how convincing it is. So, Stephen, I know you have a few more slides for us. Why don't you make sure that you highlight what you want to highlight before we part ways today?
Okay. This is the Kelly criteria. The question is, how much of your portfolio should you allocate to Bitcoin? The answer, according to Kelly, is a very high percentage. What Kelly does, and John Kelly did this work in the early 1950s. He was at Bell Labs. He was an associate of Claude Shannon, who's the father of information theory and the equation for the entropy of information, trying to work on signal to noise in telecommunications. Kelly took the basic concept and applied it to growing wealth and even games of chance. Some of this comes out of gambling theory. If you have a bet and you have a payoff and you have a win rate. So it's very simple conceptually. P is your percentage of wins in the upper right here on this slide, and B is the payoff ratio. It could be even, it could be 2-to-1, you could have an edge. And there's a lot of math. There have been volumes published on this. Ed Thorpe was the guy from MIT who was the famous one who went to Vegas, and had an edge. And but the same principle can apply to finance. You just have to determine what a bet means. You have to determine what your window size is, or it becomes a time window. And then you can calculate the optimal fraction. And this is an example of an optimal Kelly bet in a very simple case where you win or lose the same amount. It's a 1-to-1 payoff, but you win 60% of the time. Suppose you have some edge for whatever reason. It turns out that you just want to bet essentially the difference between your win and your loss rate. So the win rate is 60%, the loss rate is 40%. the difference of those is 20%. And that actually turns out to be optimal. And this curve, shows how fast you grow your wealth and how much you should wager. And if you wager too little, not surprisingly, you don't do as well. But if you wager too much, you fall off this curve and it's pretty steep. So Kelly takes you right up to the edge of what the optimal situation is, and you don't necessarily want to push beyond that. Now, for Bitcoin, it's very, very sensitive as to what time frame you use. If you use weekly, you'll get a much lower number. Quarterly will be higher percentage, yearly even higher percentage. So this is a yearly analysis. It has 10 years of returns for 16 asset classes. 8 of these turn out to be bond and bond-like, so they don't have very high returns. Across the 10 years, Bitcoin was the number one asset 8 years out of 10. It was also the lowest asset 2 years out of 10. So it's very, very interesting from an analysis standpoint. But if we take the 8 that are not bond-like, we've got Bitcoin, tech stocks, large and small caps, real estate, gold, commodities, international equities. So we want 2 numbers. We want this P, which is the percentage of time that we win, which for Bitcoin was 0.8. And for the others was 0.6 or 0.7. And then we want the average win and we want the average loss. So those are the next columns, W and L. So the average win for Bitcoin was almost 300%. The average loss was high at minus 70% just in those 2 years. And then you take the ratio of those two, and that's this parameter B. That's your edge. It's 4.2. So you've got a 4-to-1 edge from that, but you've also got a 4-to-1 edge from the probability of winning, which is 80% versus 20%, right? So Bitcoin exhibits 2 4-to-1 edges, and no other asset has that combination. Broad tech won 80% of the time, but it was an edge of 1.5. And the other best edges were large caps, not surprisingly, and gold. But they had, lower percentages than Bitcoin. So you just plug into this very simple formula, which is just P, the win rate, minus the loss rate, which is 1 minus P, divided by this edge ratio B. And so for Bitcoin, that's 80% minus 20% over 4. And so you get 75% as the answer. And that's the F column in green. And it turns out that if you say, well, 10 years ago, Bitcoin was going like gangbusters. We know about the power law. We don't expect it to do quite as well. But if you just take the 5 years, you still get a 0.71. Your edge drops to 2.3 to 1. That's still enough to give you more than 70%. So what this is saying is that if you had a 2-asset portfolio with cash and Bitcoin or T-bills and Bitcoin, you would want to put up to 70 or 75% into Bitcoin and lesser amounts in these other asset categories with those same 2-asset analysis. This is a slide from Michael Howell, who you know well and have interviewed repeatedly, I think. And this is his analysis of his liquidity index shown on the x-axis, log scale. This is natural log, the GLI index, and Bitcoin price, again on a natural log scale. And he found a power law with a 9.72 index with quite good R squared, 0.9. So that's over a span of Bitcoin from $200 to $100,000. I've redid this. I don't have access to his GLI, but I used the OECD M3 money supply global liquidity numbers because I wanted to do a longer span. So my span goes from less than 10 cents up to, the present. So that's 6 orders of magnitude. And I found an even steeper slope, 11.5, and a similar R squared of 0.86, even though it's a much larger amount of data. So this is support for the idea that liquidity matters. Here's another analysis where I looked at all the mini bubbles, which are the components of the large bubbles. And I had 31 mini bubbles. And then I used a machine learning technique called random forest and compared to the year-over-year growth of this M3, money supply of the developed economies, the OECD economies, and then also looked at the month-to-month changes, which are the delta, the ones labeled here. So the ones labeled growth are annual growth, and the ones labeled delta are the 1 month changes in the growth. And what we found is that growth mattered more than delta, and that the lags of 4, 5, and 2 months had the best correlations. And half of the importance was captured with the year-over-year growth with lags of 1 to 5 months. So the weighted mean is 3.5 months. And that's similar to what Michael has found. I think he uses 11 weeks as his typical lag between liquidity and Bitcoin price, Bitcoin lagging by about 11 weeks. So it's about 1 quarter. So I'm going to close with a quote from Warren Buffett, who still does not get Bitcoin yet, but he certainly gets stocks. He says that diversification is protection against ignorance. It makes little sense if you know what you are doing. And I think the Kelly optimization criteria shows that you can put a very large allocation to Bitcoin if you have a long time frame, and it tells you you should have a long time frame. And a different quotation, not attributed to anyone, is diversification is Wall Street's way of saying, give us your money and we'll make sure you never get rich. So thank you. And fall in love with some activity, follow Richard Feynman's advice, and be stoic. Bitcoin is stoic.
Dr. Stephen Perrenod, thank you so much. Please make sure that you are reading his work if you are interested in this mathematical approach to Bitcoin and the power law. He works closely with Dr. Giovanni Santostasi. So, Stephen, tell people your Substack and your social media so that people can find you online.
Right. My social media is Money or Debt. And my Substack is my first name and last name .substack, stephenperrenod.substack. And then we do this Physics of Bitcoin show every Wednesday at 8:15 p.m. California time, 11:15 p.m. Eastern time, live on YouTube and X.
Dr. Stephen Perrenod, astrophysicist, mathematician, and expert on the Bitcoin power law. Thank you once again for joining us at the Bitcoin Layer. We'll catch you guys next time.
Thanks so much, Nick.